of Bank of Israel. Thank you.
All right. So first of all, to everyone, good afternoon or good morning, depending on where you are. As we're all aware, Israel is currently at a war following the October 7th inhuman brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our hearts are with the innocent victims of the war, and our hope is for it to end with the safe return of the hostages and with peace and security. What I want to talk in terms of economics, I'll try to present briefly the Israeli economy, its strength and its resiliency, kind of its foundation. Within it, a little bit of into the high-tech sector. Then I'll talk a little bit about inflation, and then basically development or economic developments since the war, and a little bit at the end about outlook. So why don't we start? So first of all, Israel has shown a lot of resiliency and very high growth, including COVID. So you could see in COVID, we had a relatively mild drop if we compare it against the rest of the world. We basically had a contraction of about 2% and then immediately grew out of it and have been almost 8 quarters above our trend. Just to give you a flavor, we grew over 9% in 21, 6.5% in 22, and we're on a rate of growth to be before the war around 3.4, 3.5 in 2023. I would roughly say we were on a way to very, very softish landing in terms of both inflation, and I'll show that later, and growth. Just like many other countries, very tight labor market. That was slightly towards the end, was moderating, but still very high, very low levels of unemployment, very high participation rates, still way above pre-COVID period. Israel has shown, this is basically the debt to GDP of Israel, and you could see that over the years up to COVID, we have shown very strong and responsible trend of reducing our debt to GDP. Prior to COVID, it was just around 60%. During COVID, it went up to just around 72%. And then immediately following in 21 and in 22, we dropped back to pre-COVID level of 60%. So maybe to sum it up, prior to October 7th, the Israeli economy was in, by many metrics, very good standing, low debt to GDP, expected deficits in 23 of about slightly above 1%, relatively high growth within a global economy which was slowing down. And I'll show you the numbers about inflation. In terms of debt to GDP, you could see where we are roughly in the cross section of OECD countries or a broader set of countries. And this is something that I'll get back to with the increased basically costs that are associated with the current war. Something about I've talked about our resiliency and our ability to come back and back again after various crises. Clearly, a leading sector in Israel is the high-tech sector. It is very important for the Israeli economy. You could see it's over 50% of our export. It's about 17% of GDP. Probably those high numbers of growth that I've shown you a lot of it, 40% in the last 5 years, is due to the sector. 25% of taxes paid by that sector, and it's a growing percentage of our overall employment. So a few maybe perspectives on funding. So first of all, in blue, you could see as percent of GDP. Again, we are an outlier. If you think the US is a high tech, it has a lot of high tech, you could see that as percent of GDP, Israel has a very high percentage. That's on the left-hand side. On the right-hand side, you could see the progression of funding through the various years, where the bottom red line is basically kind of 2015 to 2019. The years post-COVID were just an immense growth in funding. We all know that somewhere around mid-2022, funding to growth sector has slowed down. And we're seeing that segment in green at the bottom is kind of back on track where it was before. And of course, this funding is important as we go forward. Something about the difference between 2001, when the dot-com blew, and the current situation of the high-tech sector. The main point I want to make is that our current high-tech sector is much more formidable, much more diverse than what happened in the dot-com in 2001/2003. I don't have that graph with me, but if I'll show you the biggest drop that we had in GDP per capita, it was actually during the 2001-2003 event. Now, back then, most of our high-tech sector was concentrated in telecom. Most of the business was relatively immature, dream companies. Whereas right now, you could see by this pie chart, first of all, it is much more diverse. The companies are a lot more mature. And on the right-hand side, you could see many of them, approximately 60% of them, have some kind of a released product. At least holding everything else equal, this is a much, much more mature segment. It has a lot more access also to funding, and it's diverse into also, of course, we're extremely well known in our cyber, fintech, and medtech, but these other sectors, as you could see, are also growing sectors within our high-tech segment. A few words, I'm a central banker after all, so I'll say a few words about inflation. First of all, Israel pretty much all along was at the bottom quartile, even at some periods below the bottom quartile of inflations among the OECD. And you could see that on the right-hand side, our current inflation is 3.7. We peaked at 5.4 in January 2023. On the left-hand side, you could see that if you look at inflation, some measure of core inflation, if you exclude food and energy, we're around 3.2%, still at the bottom quartile of the OECD. This is the kind of breakdown of inflation in Israel. Of course, it has similar components to other countries. What I want to focus on is the next graph, which decomposes it into tradables and non-tradables. We are a small, open economy, after all, and we are obviously affected by global conditions as well. So a lot of people talk about the stickiness of inflation, and that's, I would say most of the stickiness is in the non-tradable goods. That includes also shelter costs, which are about 25% of the CPI in Israel. But the good news there is that you see that that orange line, while it's still at 4.2, it is trending down. We are seeing shelter cost coming down. And to us, that is a very good sign. The tradable parts, the blue part, obviously is relatively highly affected by the exchange rate and energy prices. And given the depreciation that we had lately and some changes in the energy prices, we've seen it pick up. It's still not much lower than the non-tradables, but it has picked up due to these effects of the exchange rate and energy prices. Where is inflation expectations? For us, it's not just, and we always do this in the central bank. We're not overly dazzled by a good number, and we are careful to analyze basically the dynamics of inflation. I don't have it here, but if you look at our publications, we look at the 3 months inflation, the 6 months inflation. We want to see where is the dynamics of the inflation going. What you're seeing here is on the left-hand side, the basically inflation forecasts of 14 forecasters that we kind of monitor. And you could see that roughly towards the end of the first quarter, maybe beginning of second quarter, we are going to be in the target of our inflation. The inflation target in Israel is between 1% and 3%. And so inflation is anchored. On the right-hand side, you see market expectations, both by the forecasters and the break-evens, that is between real and nominal bonds. And you could see they're all anchored somewhere around 2.4 and 2.5. And that is very important in terms of looking forward to where inflation is going on. However, these are the means of the expectations. When I'll get to the part about the war, clearly there's been some very strong supply shocks, such as in the construction and agriculture industry, on the negative supply shocks, as many Palestinians work in these industries and foreign workers. And on the other hand, there are also demand shocks, such as tourism and things like that. So this is where inflation expectations are, but even the developments of inflation, we still need to see how did they develop given these different types of shocks that the market or the economy is undergoing. This is basically the current interest rate, both by the Fed, Israel in blue, and the ECB. We are a small open economy. Sometimes we deviate very much from the major banks. If I've given you a graph over time, you cannot probably deviate forever from the effects of the global economy, but this is a balancing act that every country needs to do what is appropriate for its own country. The monetary transmissions are different. One very clear example that I always give is mortgages. In Israel, most of the mortgages are variable rate, which means when you hold everything constant, every 1% raise in interest rate is much more effective. It affects the whole stock of mortgage takers, as opposed to, say, the US, where most of the mortgages are fixed rate, and so it mostly affects those that are the new mortgage takers. And so all these changes are taken into account by the bank when we make our decisions. Just to say a little bit about our actions, what you see on this graph on the x-axis, you are seeing number of months since inflation exceeded the upper limit of the inflation target. And on the y-axis, you actually see the interest rate minus actually realized inflation. So this is not really the real interest rate, but it's some kind of a notion of how restrictive the central bank has been and how quick and determined it has been. So for example, in green, where you see the US at around -8, that's when the interest rate there was about 1 and inflation peaked at about 9. So you could see how long of a detour it's taken. Clearly, they're in a restrictive zone now, according to this measure. We've acted, first of all, very quickly already in the summer of 21, stopping summer towards fall of 21, blocking or stopping various special loan programs that we had for COVID and our QE program. And you could see, given our inflation rate, this has been a very determined approach to averting inflation from becoming too high, which at which point the cycle can become costly to avert. Something about the exchange rate. I would say the exchange rate during 2023, as you can kind of divide it into several segments. I would say, first of all, during 2022, once tech stocks have taken a beating and NASDAQ has taken some of beating, it was natural that the shekel also depreciated. So what you see here is that until the beginning of 2023, the shekel was very tightly linked to NASDAQ, and that is a feature that our institutional investors, pension funds, etc., invest quite a bit abroad. And so when NASDAQ goes up or S&P goes up, marking to market, they make capital gains and then rebalances to shekel or vice versa. What you are seeing is that post or around January 23, you could see that the orange line sort of start departing. So the orange line is what the exchange rate would be predicted by NASDAQ, and the blue line is the actual exchange rate. And you could see they departed. And so the shekel kind of started to move towards the region prior to the war around 385. And that was, I call that an excess depreciation due to some of the issues we had with the changes in the judicial system. And then you could see the big spike there right at the beginning of the war. And then you could see in blue that it came down. And I'll explain what we've done since the beginning and some of the steps we've undertaken. So kind of the stories during the year have had different components and explanations to them. So let me talk a little bit about the developments since the war. So one important, especially for investors, one important point to make: Israel, unfortunately, has seen many military events and operations and wars. And the one thing that comes out is that pretty much after every single one of them, Israel has known to come back, and these are quarterly growth rates, and has essentially had bounce back and has had large growth after these events. And there's no reason to think this will not happen also in this case. So this is, I think, especially for you, if you look at the fundamentals that I've already explained, if you put COVID there as another crisis, you add all these things together, it basically tells you the Israeli economy and what I've said about the high-tech sector has these fundamental features of being able to come back and grow very, very fast following various crises, and in particular military ones. What has happened to this is the nominal exchange. This is the effective nominal exchange rate. And you could see this is an event study given several military events. The vertical black line is the 0 point where they started. You have 30 days before, and you have 60 days after. You could see that the current event, the shekel has depreciated a lot more, relatively speaking, to other events, probably internalizing the fact that this is a larger event. We've started it obviously with penetration to Israel, and with obviously all the numbers that you've seen in the media about people murdered, etc., and kidnapped, and probably also part of the weight being on a fear of whether this will be a multi-frontier war. As things stabilized, you could see that the exchange rate right now is even below where we started. I told you on October 6th that the dollar shekel was at 386. It's at now, yesterday it was at 3.7, depending where you look. So these probably also reflecting that some of those, at least some proponents in the market are talking that these issues that I alluded to earlier about the judicial issues are probably off the table. And the fact that we've made good grounds in terms of some of the military issues, and that the likelihood of a multi-front frontier has decreased. These are some of the steps that we've undertaken during this event. And I want to point out, if there's one lesson from economic history, you do not want a crisis, an event. If we take the COVID example, you do not want a health crisis to become an economic crisis, to become a financial crisis. Once it becomes a financial crisis, the domino effects become a lot larger, and basically the costs become much more formidable. So already, and analogously here, it was very important for us to stabilize the markets very early on, and we did it on October 9th when the FX market opened immediately after the October 7th. And what we did is we basically created a program where we would sell up to $30 billion in reserves, a $15 billion swap transaction. And we set out right. We don't target it. We didn't target a particular FX rate, but we wanted to make sure there's enough liquidity, there's enough stability, there's not a sense of panic or overshooting, that the market functions fundamentally well. We also opened the stock market, as was mentioned, the stock market on Sunday here. And the main point was this effect, I believe, and had a periphery effect, not just on the FX market, but on the bond market, on the stock market. They all performed and functioned accordingly afterwards. We also created a repo transactions for institutional entities. I would say the one thing we added at the end, about a week or so ago, is low interest loans to banks, conditional on them providing credit to SMEs. Those are the most vulnerable firms, and this is something where we give the banks a little bit a rate that's slightly lower than the Bank of Israel rate, provided they pass that on to the SMEs. What we've done, so it was very important for us, as long as risk premia is high, and is to really focus on market stability, and we're still very highly focused on that. But on the other hand, and this was the two-pronged approach that we've taken, was to provide certainty for the people around the border that got hurt, the many people who got called for reserve duty. And so what we've done together with, we supervise the banks. What we've done is we created a program for deferring loans, free of interest, free of fees to the victims and reserve soldiers for at least 3 months. We did it also within, I think, by October 10th or so. And so that was very important to instill certainty and for this set of population to make sure that there's certainty on that side. One can think of that in economic terms. So this is for mortgages, for consumer loans, and again, for some SME loans. And one can think of this as almost targeted, very, very targeted interest rate easing for this particular segment. And then one of the issues that I do as the governor, which is the last point on the right, is the economic advice to the government. This is something most central bankers don't do, and we are very involved in part of the fiscal support that has been given to the various firms, etc. So what has happened to the stock index in Israel? So the year to date, you could see on the right-hand side, has not performed very well, but you could see that since the 7th of October, we are still an outlier, but since the 23rd of October, where things, at least militarily and the markets have somewhat started to come down, you could see that Israel has been a top performer in terms of the stock market. Over here, you see the CDS, the 5-year CDS of Israel on the right-hand side. It jumped, and initially, and after 2 weeks or so, it stabilized, and it's actually came down somewhat. You could see it on the left-hand side with the blue, the blue number. You could see the spread between Israeli 10-year dollar-denominated government bonds and U.S. 10-year Treasury bill. You could see that also went up, but has come down somewhat. It is still at elevated numbers, reflecting the fact we are still at a war. So there's still large uncertainty, but we haven't seen it. We've seen it sort of slow down and come down somewhat. And you could see in gray on the left-hand side, this is the 10-year Israeli shekel nominal yield, since we're going to have to increase our local debt as well, and we have large institutional market that can absorb, I believe, can absorb it. And you could see it hasn't gone up by any discernible means in any way. Most of our debt is still in local currency. What about inflation expectation? Long one. So here you see the 5 to 10 year inflation expectations. This is again an event study. You don't see a big change here. This is probably reflecting again that we know how to manage this economy. The economy can come back. And this is very important. In terms of corporate spreads, yeah, they did go up initially, and then they basically came down, except the construction, some segments within the construction industry that are still somewhat elevated. They are almost pre-war levels. What about the real activity? One quick measures of real activity is credit card expenditures. Just like in COVID, in gray there on the right-hand side, it initially dropped by almost 25%. You could see at the very tail end there, we are back to 96%. There are some segments like tourism, other maybe theaters, etc. It will take them a little bit longer to come back, but this is reflecting the fact that the economy And anybody who spends time in Israel, you could see it, restaurants, you could see it by congestions on the roads. People are back, the economy is refunctioning again, and this is a very quick and important measure for us. A few words about the outlook. The expenditures that, where's our estimate of, so let me first start with this. We are, our estimate for GDP growth for this year is to end at about 2%. The 2.3 there is our previous estimate after the war. But as I mentioned, we were on a track of a 3.4, 3.5 prior to the war and slightly above 3 for 2024. This is our current estimate under the scenario in which the war goes on still into 2024, but then at a slower and slower intensity as we go and continue into 2024. And it is primarily in the southern region. You could see the other numbers there. The wide unemployment rate includes those that are laid off to paid on leave with unemployment benefits. So this is why the numbers are higher than the numbers you've seen on the second slide on unemployment. And you could see where we expect inflation to be sort of at the average of the last quarter of 23 and 2024. The important number is the debt to GDP ratio. I like to focus primarily on 2024 because 2023, there are many ways on how exactly the receipts will be accounted for in 2023. What we see is basically debt to GDP growing to 66%. Basically, the breakdown that we are seeing in terms of the cost of the war is these are expenses that are going to laid out between 23 and 2024. You could see they include obviously security issues, compensations for damages, other civilian expenditures. Just like in COVID, we support firms in various ways, and then slightly higher payments on the increased government debt. And then, because of the slower economy, this is loss of tax revenue relative to where our estimates were before. This is broadly the economic breakdown of the economic cost of this war, or the fiscal cost of this war. And this is about 10% of GDP. In terms of loss of GDP, it's about a cumulative loss of 3% of GDP relative to that first graph where I show you the level of GDP. So going forward, and basically this is Israel's military expenditure in Israel. You could see it's naturally high. It's about 4.2% relative to GDP. Relative to, and you could see it's high given our geopolitical issues relative to other countries. And yet, on the right-hand side, you see the civilian public expenditure in Israel is not that high. So the real question going forward is to make sure that we make the appropriate adjustments in public spending so that somewhere in 25, in 26, debt to GDP starts making an inverted U shape. And in order to do that, we will need to make adjustment because probably security cost will have to increase on a more permanent basis. And basically the 2024 budget will have to be reopened. And we have ongoing discussions with Ministry of Finance and the rest of the government. And we will have to come down with some adjustment that will have to focus on areas where, let's say, they are less supportive in terms of engines of growth, and to do the adjustments right there so as to make sure that over time, as we come back and grow in 25, as I've shown you before, this debt to GDP sort of reverts back towards the 60%. And I believe these are manageable things that the government can do. And we will probably have to do them in the next month or two. I think people in the government understand that some of these adjustments will have to take place, and they will have to reprioritize maintaining as much as possible growth engines in terms of the budget, and on the other hand, take out in particular some permanent components that are less needed in order to compensate for this partly temporary growth in debt to GDP and the longer increase in security cost. We in the BOI, obviously in the bank here, will continue to do our job. You saw that slide. I wear 3 hats: monetary policy, bank supervision, and of course, economic advising to the government. You essentially heard my speech and advice on the fiscal side, and I believe this will be the work that will have to be carved out in the next month or two. On the banking side, the banks here are very stable, very formidable, and that's why they can actually do all these deferrals. They have all the capital buffers to do those things. And then on the monetary side, in view of the war, I'm just basically telling you our the statements that we just made this week in terms of the interest rate decision. The monetary policy is focusing on stabilizing the markets, as I've shown you, and reducing the uncertainty. But this is alongside price stability and supporting economic activity and growth. It implies that the interest rate path will be determined according to the developments in the war and in the uncertainty that is, inevitably connected with it. But as long as, and in so far as recent stability, and we've seen that stability come back in financial markets, becomes entrenched, more entrenched, and inflation environment continues to moderate as we expect it to be towards the target range. Basically, our monetary policy will be able to focus more on supporting economic activity. I'll stop here. Thank you very much.